What's up, guys? My name's Adrian, and welcome to another episode of my monthly video series where I present to you my TSX dividend stock picks of the month. So, in last month's video for my May stock picks, I focused on the real estate and restaurant industries, both of which have taken a pretty big beating because of the COVID-19 pandemic. So, if you haven't seen it, make sure to check it out because a lot of those picks are still really good buys right now. So, just a quick disclaimer before I unveil my stock picks for June. I am not a certified financial advisor or have any financial background whatsoever. I have been investing in the stock market since 2012 on my own and manage currently a portfolio of about $600,000, which makes $4,000 a month in passive income. So I definitely consider myself an income investor, and my investing strategy exclusively deals with dividend paying stocks. So my top priority will always be the safety, consistency, and the yield of the dividend. So let's get started with the picks. So pick number one is the Harvest Energy Leaders Plus Income ETF. So stock symbol is HPF. So this is a portfolio of 20 really large blue chip global energy companies. So the ETF is designed to provide a consistent monthly income stream with an opportunity for growth. And in order to generate an enhanced monthly distribution yield or dividend yield, an active covered call strategy is used. So notice the covered call strategy is underlined there. So I recently made a video discussing what the covered call strategy is. So if you have no idea, click on the link and make sure to check it out. So looking at this ETF's 1-year high price of $4.38, it was giving a dividend yield of 8.22%, which is already very, very high. But if you look at the most recent price of $2.38, it translates into a dividend yield of 15.13%. So it's absolutely crazy on how much money you could make in terms of passive income with this ETF. So let's check out the reasons why now. So energy stocks were battered by COVID-19 because the demand for oil dropped significantly due to all the travel restrictions. So oil demand and oil prices are actually rising right now as the global lockdown measures are easing up across the world. So this ETF only includes blue chip energy companies, which is great because there's a lot less risk involved. And the ETF is also diversified in terms of region. It does focus a little bit more on the US with 55%, but it's not all in Canada, let's say. So my takeaway for this pick, it's a great entry point for investors who want to invest in the energy sector right now. It's a crazy monthly dividend yield, obviously. I would say a dividend reduction is possible, but very unlikely. Either way, even with a reduction, the yield would still be very high. So well worth it in my opinion. And obviously this ETF does have a covered call strategy, which boosts your income by providing a second source of income. So a good alternative to this ETF, if you want to get on the energy sector, is the NXF ETF by CI First Asset. So that ETF is very, very similar, except it has no Canadian energy exposure whatsoever. So if you want to invest in energy but you want to stay away from Canada, that would be a really good alternative ETF for you. All right, so pick number two is also an ETF from Harvest. It's called the Harvest Healthcare Leaders Income ETF, stock symbol HHL. So in this ETF, you have a portfolio of 20 blue chip global healthcare companies selected for their potential to provide attractive monthly income and long-term growth. So in order to generate an enhanced monthly distribution yield, an active covered call strategy is used, just like the first ETF I covered. So if you look at the price now, so the 1-year high price was $8.26, giving a nice dividend of 8.43%. But there's a little bit of a discount right now. The ETF price is currently approximately $7.68, which is giving a dividend yield of a little over 9%. So really good for a safe sector here. So this is an easy and safe way to invest in the powerful US healthcare system. It's considered a really defensive sector, healthcare, because healthcare is pretty much essential. And this sector has remained really resilient during the COVID-19 pandemic. And also Bernie Sanders is no longer a threat to US pharmaceuticals because he dropped out of the US presidential race. So my takeaway for this one is that the healthcare companies They make a lot of money, a lot of profit, and are very powerful, especially in the US. So this ETF is a great way for us Canadians to really get in on that action. This sector should continue to thrive due to aging populations around the globe. So people are living longer, which means they'll need more medicine for a longer time, as well as medical services, so it's pretty much a no-brainer. And also this, like I mentioned before, this ETF also uses a covered call strategy, which boosts your income by providing you a second source of income. All right, so pick number 3 is what I like to call a hidden gem on the TSX. It's probably a company you never heard about. It's Diversified Royalty Corporation. Stock symbol is DIV. So this company is basically a royalty corporation that acquires royalties from well-managed businesses in North America. So their objective is to acquire predictable growing royalty streams, and they expect to pay a really predictable and stable dividend to shareholders and increase the dividend as cash flow increase. So they currently own trademarks to 6 businesses. So Mr. Lube, Sutton, and Air Miles makes up the bulk of their royalty revenue right now. So Mr. Lube is a pretty popular chain of automobile services in Canada. They do things like oil changes, tire changes, things like that. Sutton, they're residential real estate brokers. Air Miles, everyone knows Air Miles. It's one of the most popular loyalty programs in Canada. Then you have Mr. Mike's, which is a chain of steakhouses, Nurse Next Door, which provides medical services, and Oxford Learning, which is educational material. So the 1-year high price, it was $3.44, which gave a dividend yield of 6.83, and the recent price is a pretty big discount right now. It's at $1.75, which is giving a dividend yield of 11.43%, so really, really high. Okay, so my justification for this one is that this company exists really to pay a dividend to shareholders. That's fantastic. They invest in stable companies that are really well established, which is good. So Mr. Mike's and Nurse Next Door, their trademarks were acquired in 2019, and Oxford was acquired in 2020. So some really good recent pickups there. So they raised their dividend twice within the last 2 years. So it was 22 cents, and then they raised it to 23.5 cents. But unfortunately, because of COVID-19, they reduced their dividend in April from 23.5 cents to 20 cents. So it's a dividend reduction of 15%. It was due to COVID, and in my opinion, it was really small and justified because some of their businesses are suffering and are unable to pay their royalties to the company right now. Companies like Mr. Mike's, because they had to close down their restaurant. So this is a great entry point for investors. It has great upside potential because they increase their dividend after a new trademark is purchased. Also, in my opinion, the dividend is unlikely to be cut further, but if it is, it's likely to be very minor. And also keep in mind that the current dividend yield of over 11% already includes the dividend reduction. So a really great entry point for investors looking for high dividend yield. So my last pick is Bridgemarq Real Estate Services, stock symbol BRE, probably another stock you've never heard of. And let me tell you, this is also another gem on the TSX that doesn't get much attention because it's a very small cap company. So this company is basically a provider of services to residential real estate brokers and they have a network of more than 18,000 realtors operating in Canada under the brand. You probably heard of it or seen the posters, Royal LePage, Via Capital, and Johnson & Johnson brands. So their objective is to provide superior services to real estate brokers and produce an attractive return on investment to shareholders through equity appreciation and growing dividends. So that's taken right off of their website. By the way, the last dividend increase was in mid-2017. They increased the dividend at 4%. So the 1-year high price for this stock was $16.85, giving a dividend yield of a tiny bit over 8%, which is really good. But the stock took a pretty big beating, but it's already recovering nicely. So the most recent price is $10.12, which is currently giving a dividend yield of 13.34%, which is really, really good. My justification for this pick is they simply have not missed a dividend payment ever since 2004. Always a fantastic sign. They released a press release on May 14th, so very recently, and they advised that their shareholders that business measures were put in place to protect distributions, which is just a fancy way of saying dividends. So I really like that press release to really calm investors down and tell them that their dividends are safe. So in my opinion, a dividend cut is unlikely because the real estate market will start picking up once the government COVID-19 measures are loosened. And this is a really good way to make money from those crazy commissions real estate brokers make. Everyone knows that real estate brokers make really good high commissions. Trust me, I would know. I recently sold my condo 6 months ago and I had to pay a commission of over $20,000 to them. So no point getting mad at paying the commission. Instead, you could just invest and start making that money yourself. So my takeaway for that one, for this one, is that it's a well-established real estate service brand. I'm talking about Royal LePage here. It was founded in 1913. So the price drop because of COVID was exaggerated in my opinion. The stock was pretty stable at $14-15 pre-COVID and then dropped to $6 within 1 month. So the stock is actually recovering fairly quickly, especially after they put out that press release. So it's now at $10, but it's still down a third from normal. So it's still a really great entry point for investors, but we need to act quickly. So really good dividend yield and a really good way to make money off of those real estate commissions. So there you have it, folks. Those are my picks for the month of June 2020. As usual, you could download the presentation for free. Just check out the video description below so you could access the document. Also, don't forget that in the presentation, all the stock symbols are hyperlinks. So if you click on them, it will take you to the page of the company or the fund. So you could, if you want to read up more yourself. So please let me know if you agree or disagree with any of my stock picks, or let me know if you have any stock picks of your own that you would like to share. I'd be more than happy to check them out and provide my opinion on them. So finally, make sure you're subscribed and click on the little bell next to the subscribe button so you don't miss out on my future stock picks for the month, as well as my other investment videos. So take care, guys, and see you next time.